The producer price index for August up more than 8% from the previous year, its highest reading in at least a decade. So with yet another data point coming in higher than expected, is inflation really transitory? Joining me to discuss, maybe even to debate, Peter Bookvar is Chief Investment Officer at Blakely Advisory Group, and Gina Sanchez is CEO at Chantico Global and Chief Market Strategist at Lido Advisors. Welcome to you both. Peter, I know you've been warning for some time that cost pressures will remain elevated. How elevated and for how long do you think?
Well, as we progress into 2022, they'll get less elevated. But the question is do we go back to where we were pre-COVID with consumer prices printing 1 to 2%, or do we have for a period of time a higher plateau? Is it 3 to 4% instead? And I'll argue that 3 to 4%, while it's slower than the rate we're seeing now, is a big problem, because $15 trillion of negative yielding bonds is not a good setup with 3% inflation. A 1.3% 10-year yield is not a good setup with 3% inflation. An S&P 500 trading at 22 times earnings is not a good setup with 3% inflation.
So basically, Peter, you think that there's no... I'm almost starting to wonder if we had 3% inflation, if people would still hold treasuries. I don't even know if the yield hasn't. I know that flies in the face of, how finance is supposed to work, but it seems obvious we're going to be at higher than 1.3%, but maybe not over a 10-year time frame.
Well, I want to believe that there is some market left, free market left in the treasury market, and that if the markets were disabused of the thought that this is just transitory, and if we were well into 2022 and inflation rates are still elevated, which I think will be the case, then the long end of the yield curve should adjust. But then the question is how much is the Fed going to fight that? And how much are they going to sort of distort the market and not let the market reflect where they think things should be priced?
Right. So, Gina, let me turn to you, because I know that I don't want to say you're in the transitory camp, but I think you're less concerned about sort of persistent cost pressures as we head into 22 and beyond. So, and again, you're picking investments based on this view. So tell me about this. How much does it differ with what Peter's describing, if it does?
So one of the things, when I talk to people about inflation and I ask them, what do you think the Fed means when they say transitory? Most people think that means that price levels go up and then they come back down. Something like what happened in 2008 with oil prices, and again in 2011 with oil prices, where prices went up, hit big numbers, 140, 110, and then came back down to low numbers. But actually, there's two other versions of transitory inflation that still actually meet with what's just been described. The first is that you have a one-time price shock, and then prices remain elevated, but don't really change much after that. So the change goes down, but your price levels are permanently higher. The second is that prices go up, and then they continue to go up just more slowly. Both of those things actually technically qualify as transitory inflation. And I would make arguments that wages, for example, right now we've actually had twice the level of retirements during the pandemic that happened in 2019. A lot of people have retired, and so you have a lot of companies looking to replace those. There was a lot of sort of wage compression that had been locked up in the wages that they were paying, and now they're having to go out into the open market, and all of those wages are adjusting upwards. But I would argue that that's probably not going to continue for many years. I would argue that that's probably a 1 to 2 year adjustment. Wages then start into their wage adjustment, their wage compression cycle, and we have low inflation again.
So, Gina, it's obvious, Peter's not that interested in holding a 10-year treasury at these yields. Would you?
Well, who loves treasuries at these yields? They're terrible. But the reality is that that you have, quite frankly, an everything is too expensive market. Everything is too expensive, Kelly. Equities at these levels are too expensive, right? And so, to some degree, some inflation is actually quite healthy, especially if it comes in through wages, because higher wages portend higher consumption. Higher consumption portends higher growth. All of those things are actually good for equities from a fundamental basis, because the fundamentals haven't been there for a very long time. All we've had are margins, probably for the past decade. And so I think we need some inflation in order to get back to good fundamentals.
Peter, it's almost like what Gina's describing is that the whole society has a high PE ratio, but she thinks the E is going to come up because, the wage is going to kick in, and that's how, things might look out of whack right now, but not if people have, more disposable income. But then I guess the point would be they can afford higher costs, which would then kind of make your point about the persistence of cost pressures.
Well, it is a good thing from an employee standpoint that we are seeing higher wages now. The problem, year to date at least, is that inflation is running faster than wage growth. So we're actually seeing a decline in real wages. So yes, hopefully we'll continue to see that wage increase. But if inflation runs faster, then that's not a good thing. I am not in the camp that a little bit of inflation or even more than that is a good thing, because that reduces real wages. I want to see very low inflation and stronger wage growth that's driven by productivity. I don't want to see wage growth because there's a lack of workers or for other reasons. I want to see higher wages because there's strong productivity. That is healthy wage growth, not because there's a dearth of workers.